Welcome to this mock test. This mock test is called Prudence. Before continuing with this question, as always, please remember you should attempt this question yourself first, mark yourself to the suggested solution, and identify any mistakes that you've made. Why did you make the mistakes? Go and investigate those mistakes thoroughly. Make sure that there's not an indication that there's a gap in your knowledge, your understanding. Remember, guys, typically, if you make the mistakes whilst doing these things at home while you're studying and practicing, there's a big chance, if not almost a guaranteed chance, that you will make the same mistake in the test or the exam. So fix those gaps up before you go and write your tests and your exams. As always, guys, please note also in the beginning here that I provided you with tax rates and tax tables which I have created for this question. They're not correct. In the test or exam, you must always use the latest Psycho Student Handbooks rates. And if you don't have the latest Psycho Student Handbooks, you'll see that they will also provide you with the necessary rates, tax tables, etc. in the exam. Please use those. The ones for this question is purely for illustration. You need to be able to focus on the principles on this. These ones work exactly the same way as they do in the Act. So focus on the principles. Don't study these amounts off by heart. You have to consult the latest rates in your tests or exams. They change every single year. So please do make sure to do that.
Okay, so let's start. This question consists of 3 unrelated parts. So that's always important, guys, for you to pay attention to, because it means that the different parts won't necessarily affect each other. If they are related, you have to be aware and on the lookout for that as well. What are the links? How do they affect each other? So part 1. Prudence Ntombi is 45 years old. See that she is younger than 65, and she was born in Germiston, South Africa, and has been a resident her entire life. Right, so resident, worldwide income, nothing strange there. She completed both her degree and postgraduate degree in human resources at the University of Cape Town and formally entered the job market when she was 24 years old. For the last 10 years, Prudence was employed by Exactico Limited. She resigned in January 2018, and February 2018 was her final month of employment at Exactico. Prudence resigned because she had decided to take a position as head of the HR department at Vagaries Limited, a company involved in various retail operations throughout South Africa. Prudence's employment with Vagaries will commence on the 1st of March 2018. Vagaries has offered Prudence employment with an annual cost to company of 850,000 rands, which excludes UIF and skills development levies. Vagaries has indicated that it calculates the cost to company using the following formula. So how do they get that 850? They say A plus B equals 850,000 rands. And how is that? What does that mean? A is the annual salary amount, and B is either a travel allowance or a company car. Vagaries calculates this value by taking the market value of a vehicle and writing it off over 3 years. This is for employees with a company car. So let me just explain to you what that means. Let's say they buy a car with a cost, so the company buys a car with a cost of 600,000 rands. Then they'll say, okay, what happened? They just do this calculation. They're not saying this is depreciation or anything. They say that's 200,000 rands. So that 200,000 rands becomes B, 200,000. So that means then A, the salary must be 650,000. So you can see how it works. So whatever the value of the car is here, it will affect B, which changes the salary. Travel allowance is obviously a cash amount. So if they give, so obviously that should be quite logical. If they give you a 50,000 rands cash travel allowance, so B is then 50, then A must be 800,000. All right. So you see that's the idea there. That's the company, what the company is doing. They say that's how we determine cost to company. That's not to say that's how tax works. That's just what they're doing. You can do whatever you want. Vagaries has indicated that it wishes to pay Prudence a cash salary of 610,000 rands per annum. Prudence can then choose either option A or B. All right, so you can see what's going to happen. So if you make A 610,000, then it means B must be 240,000. Right, so 240,000. So see what that then means. That means Prudence can then choose either A or B. A requirement of receiving the travel allowance in the company car is that she maintains an accurate logbook. Okay, so she has a logbook. Option A, she will get a travel allowance of 240,000. See, 610 plus 240,000 gives you 850. Company car, under this options, vagaries will purchase a company car for a cost of 720,000. Right. Can you see? If A is 610, then B must be 240. 240 times 3 gives you 720,000 rand. So that's the value of the car that she can get. All right. Prudence expects to travel a total of 42,000 kilometers, of which, sorry, it says all which, that should just be of which 31,000 kilometers will be for business purposes. Right, so that's the first part. Part 2. Thomas Jones was employed by Brickmakers as a financial manager in 2012. On the 1st of July of the current year of assessment, Thomas was promoted to the financial director of the company. As part of his new remuneration package, Thomas was offered the option to purchase 150 shares in Brickmakers at a cost of 1,000 rands per share. This represents 3% of the shares in issue by Brickmakers. Similar options are offered to all persons who are appointed as directors of the company. Right, so you can see this is not to all employees, only certain. Conditions of the offer stipulate that Thomas cannot dispose of the shares in Brickmakers for a period of 3 years after accepting the offer. The shares may, however, be disposed of if the employee resigns before the expiration of 3 years. So this is a restricted instrument. Right, so we're going to look at section 8C. So, how does the rules work? When the shares are obtained for section 8C, you include in gross income. If not vested, section 10(1)(n)(d) will apply. We invest, then include in gross income. Now we'll do the whole proper calculations. I'm just reminding you of what happens here. So when this person receives it, they can't dispose of it. Thomas can't sell it when he receives it. So in the current year, he can't do anything with it because he has to hold it for at least 3 years or he needs to resign. They say on the 1st of August of the current year of assessment, he accepted the offer and transferred 150,000 rands to Brickmakers, which is 150 times 1,000. Thomas plans on selling the shares after 3 years, provided the market value of the shares exceed 1,000 rands per share at that time. All right. And then part 3. Rashid Suwi turned 65. That's important, on the 19th of October. He worked as an IT manager of SEPA Pty Limited. He officially retired at the end of October. The information below pertains to Rashid's 2019 year of assessment. So that tax year runs from the 1st of March 2018 until the 28th of Feb 2019. He's 65, guys. Pay attention to that. It's important. It means he has things like secondary rebate. It means his Section 6B is calculated differently. He earned a salary of 65,000 rands a month. Right, so let's actually just quickly do it like, let's do this proper. So 1 March 2019 until 28 Feb, 2019. So 1 March 2018 to 28 Feb. And then they say end of October. Right, so 8 months. Right, that he was employed. Rashid belonged to the SEPA pension fund. The following rules of the funds are applicable. Each employee is required to contribute 8% of their salary to the SEPA pension fund. SEPA will contribute 4% of each employee's salary to the SEPA pension fund as a company contribution. So that's a fringe benefit. In terms of the rules of the fund, retirement is at the age of 60. So he qualifies for retirement. After this, employees are permitted to remain members and to continue contributing to the pension fund until they officially retire. Right, so that means when this person, if he receives anything from the pension fund now, payouts from the lump sums, we will use the retirement lump sum table. Just to remind you, we get two different types of lump sum tables, the withdrawal one, the retirement one. So we'll use the retirement one. And the retirement one is always more beneficial. Past contributions by Rashid to the SEPA pension fund that had been disallowed as deductions amounts to 120,000 rands. Now remember the order, what we do, apply that. First, we do it against the lump sum. Second, section 10C. Third, section 11F. That's always the order in which we apply that. So if you use it up against the lump sum, it's used up. Rashid pays 5,000 rands per month to Discovery Medical Aid for the membership of him and his wife. So taxpayer plus one dependent. Rashid at no point informs SEPA of these contributions. Okay, so this is important. This means that SEPA can't take that into account when calculating his employee's tax. You can only take it into account if the employer is paying it or if they are aware of it and they've agreed to take it into account. And they said Rashid incurred additional medical expenses of 50,000 rands in respect of a back surgery that was not covered by Discovery Medical Aid. The SEPA pension fund paid a lump sum of 2.8 million rands to Rashid on the 1st of December 2018. This is the first lump sum of any kind that Rashid has ever received. Rashid transferred 900,000 rands of the lump sum to a pension preservation fund that would invest the funds and retain it until Rashid turned 72 years old. The SEPA pension fund commenced with paying Rashid a monthly pension annuity of 60,000 rands. Right, that is where section 10C would come in if you haven't used those past contributions that we see over there. Also important for you guys to see here, they say it's the first lump sum of any kind. Why is that important? So thus, there's not going to be any hypothetical tax. So no hypothetical tax on prior year lump sums. Remember guys, if you received prior lump sums in the past, it all accumulates now. You have to then calculate what the hypothetical tax would have been on the lump sums that you received in the past and take that into account for your tax liability. If all of what I've said there to you sounds like something you've never heard before, you have to go back and revise retirement benefits. You're missing important parts of the thing. Okay, that's it. So in our next video, we'll start with the required.